I want to take this question first to Ravi.
So, as much as tariffs are going to be part of the next 3 years, so is a trade deal. EU FTA we just signed. So, if stocks have become cheap based on tariff deal not happening with US, probably we can focus on companies that are focused on geographies like Europe. So, I don't think tariff can determine an investment policy or investment framework. Yes, you have to ensure that you don't have too much exposure with US. And if you're at a receiving end of the tariffs, then that should not be too much of a exposure. But at the end of the day, finally, what is going to hold you in good stead is a company that can build adjacencies, can diversify geographically, has that economic moat to survive a tariff period as well. And that is what, and good valuations, that is what is going to hold you in good stead finally. I don't think one should try to move their entire portfolio based on US deal happening, not happening, because tomorrow if it happens, then you cannot go about suddenly changing the entire portfolio.
Can the budget do something, Ravi, for this? So one is the portfolio, second is what the government can do for this.
No, government is already doing whatever it can, and a lot of it is happening outside of the budget. So GST cut happened outside of the budget. I don't think there is ease of doing business, more focus from the longer term perspective in terms of attracting flows. All those kind of things government will do, but I don't think there will be any specific step that because there is a tariff imposed by US on us that let's do something. We have to just unclog our plumbing system in the regulatory framework so that money can come in easily.
In terms of what, the first part of the question, what sectors should retail investors look at in the world of tariffs continuing for the next 3 years? Any answers there, Saurabh?
I think the answer is diversify, right? India is 3.5% of global equity markets. Most Indians have 100% of their equity exposure in India. I think that's a little over allocated to India. So diversify, at the very least, think about a 50-50 allocation, where markets like Europe and America, which account for 70% of global equities, should in due course end up becoming half of your equity portfolio. And within India, the half that you keep in India, diversify within India. So what I often see is Indian investors have preponderance of their investments in small and mid cap. Again, that's, I think, overly risky. So within India, diversify, move at least half of your money, ideally 70% of your Indian allocation to large caps, keep 1/3 in small caps. And then, as I said, given that India is only 3.5% of global equity markets, think about moving half your portfolio into global equities. There's plenty of, across Europe, across America, small and mid caps are trading at 26-year lows. You're getting the reverse of what you're getting in India. You're getting 26-year highs in India. So diversify, with or without tariffs. I think Ravi is right to say tariffs will come and go. With or without tariffs, it makes sense for Indian investors to diversify globally.